Welcome back, everybody, to the JSS Podcast. I am your host, Byron Enriquez, the casual executive, and your local finance bro. Try a little different setup this afternoon. Get a little more technology savvy over here with our team, so excited. Um, Today, just in kind of prepping for today's episode. Um, one of the things that have been going on, and I just thought it's just important to talk about it. It's something that it's on everybody's minds. Not everybody knows what to think about it or how to really get into it. And I'm talking about the conflict that's been started, political conflict with the U.S. and Iran, the bombings, and all that turbulence that's kind of occurring in the market, not in the market, in the world. And I know that everybody has a lot of thoughts about it. Everybody has a lot of feelings with whenever things like this happen. But today, I kind of wanted to dive in a little bit about um, the effects that geopolitical activities, this one a little bit in particular, but just in general, and how to prepare for these types of incidences, how to prepare, how to protect your portfolio, how to protect your investments. And I think it's important for us to really take a look at this. One of the things that I have said it before that really I hate when hearing people say, "Oh, this doesn't really affect me." It doesn't affect my little bubble. It doesn't affect my circumstances. And sometimes you know small individual things may not affect you directly, but indirectly it does. It affects all of us. And everything that we do. In particular, with the bombing of Iran and the things that are happening in the Middle East or in that part of the world. We all know, right, where all big portion of the oil comes from. So this is really causing a lot of, and I have a lot of notes, so I'm going to be looking down a lot today. It really causes a lot of strain on that side of the economy where oil prices are higher. It increases a lot of volatility. One of the things that the markets don't like is uncertainty, and it really injects a lot of uncertainty in the markets. In a lot of different aspects of it. I'm going to focus today a little bit on the real estate side of it, like we talked about. But I'm also going to feed a little bit into how having different alternative investments, what are the better types of investments to have in these types of times with a lot of uncertainty. Um, so just kind of globally to talk about that, right? It's with the pressure that's going on, the tension that's going on in Iran. It's putting that tension on the Strait of Hormuz, right? Where without getting into the all the geographic side of it, it's a very narrow channel that I forgot what the number for 35-40% of the world's crude oil, LNG, natural gas flows through there on tankers. Um, Ron has said that they're gonna not allow those tankers to come through. So what does that do? That stops the flow of energy, right? That stops the flow of petroleum, natural gas, things that's needed for pretty much everything that we do in our country, but just all the product manufacturing, food, transport, all those things. So what does that do? That's inflationary, right? It causes a lot of inflation to hit our to hit the market. Um, it's causing costs of goods to go up, right? Everything that we're importing, anything that uses petroleum, anything that uses natural gas, prices are going up, right? So if the barrel of crude oil is it's getting more expensive, gas is going up, not just gas, delivery costs because things have to go on trucks, planes, all of it, right? Anything that's petroleum based, you're gonna see that. So what that does is that causes inflation to go up, right? And I know that's a big talking point politically that everybody keeps talking about, like inflation, inflation, inflation. But on top of that, it's for what I want to talk about today is when you get these higher inflationary markets, um, interest rates rise. One of the things that people have been hopeful in the real estate market is with the the switching of the Federal Reserve president, hopefully, not hopefully, but coming in the next couple of months, um, that the new directive is to try, as much as it shouldn't be political, they're getting putting a lot of political pressure to reduce interest rates, right? And my opinion, it is premature to do so. But even then, there's a lot of political pressure to reduce interest rates, right? To make affordability and all the things, all those, those talking points that the politicians love to talk about. But when inflation hits, you can't lower interest rates, right? Interest rates are going to get bumped up. We're already seeing an eighth to a quarter percent interest rate hikes, which, yeah, it doesn't make huge difference in your affordability, but you know, when one of the things we had been talking about is that in the last couple of years, as interest rates have been higher, people were kind of grasping at and hoping for allowing that market, the interest rates to come down to be able to refinance, and people bought homes or properties. That weird adage that people talked about that I hated. Uh, you know, uh, Marry the house, date the rate. Meaning, if you love the house, buy it. Don't worry about the interest rates. They're going to come down. You'll refi later. Well, it's been a couple of years and people are still not refinancing. So they're still holding on to those higher payments that maybe were a little bit out of their budget. So it's creating, it's going to create another downshift in those people who were looking to refinance to maybe be able to stay in those homes, who maybe budgeted for maybe 2 or 3 years worth of higher interest rates. So if that kind of changes and we're not on that horizon anymore of those interest rates lowering, then you're going to get, that the less, it's going to become more your affordability isn't going to increase that people kept talking about with as interest rates drop down a little bit, you can buy a little more expensive house, right? You can afford more, but that's not going to happen, right? And this is the uncertainty, right? We don't know. This conflict can be over tomorrow, could be over in a couple of weeks, could be over in a couple of months, could be like most of our conflicts in the last years, for us to get out of that country. So who knows? So yeah, my thing is, it's impossible to forecast what could happen. Um, but we could just account for that uncertainty and how that applies to our investments, how that applies to our capital, how that applies to our risk tolerances, and what we do in that matter, right? Um, all these geopolitical factors or anything, it doesn't destroy our investment opportunities, but it does bring opportunities for more discipline, right? And one of the things that we've been talking about the last couple of weeks is having systems in place, having discipline, not just being a hustler, but having that CEO mentality of preparing for worst case scenarios, right? And these are those times. So having that discipline, and hopefully you've kind of walk through your portfolio, whether real estate, stocks and bonds, anything that you invest in, um, and you've created a structure to it where it is a system, and you have these stop gaps in place, you have these stop losses, and you have these protections and guardrails in place to be able to protect, and guide you through these times. And I think it's real important to at this time, really really fine tune, like we talked about, and having that discipline in your investment side. Let's talk a little bit. What happens to the markets, right? In these political conflicts, right? We talked about oil prices rising. We talked about inflation. The bond yields fluctuate. Equity, right? It becomes more volatile, and it starts to shrink, in the sense that it causes fear, right? So those over yeah, it causes fear. So you're not getting those people pushing the envelope as much as to drive equity, to drive prices higher, in a lot of different markets, right? Um, but then if you turn it to real estate, right? And one of the things that I've always kind of preached is real estate is a hard, tangible asset, right? Regardless of what the stock market is doing, regardless of what the bond market is doing, regardless of what's how inflation is, real estate usually, can outpace a lot of the inflation. It can outpace a lot of the stock market pitfalls, right? Because you have a hard, tangible asset. That being said, it's how your investment strategy is with your asset that will dictate your success, right? If you're looking, if you're investment or your real estate investment, your asset, it's an income producing asset. You're collecting money every rent. I'm sorry, collecting money every month by rent. Then that's not really going to change, right? Um, One of the studies that people have done is that even when inflation hits really hard and cost of goods goes up, the first thing that people always figure out a way to pay is their housing, right? Either be the mortgage or the rent. So for the most part, that's the first bill that always gets paid, right? Credit cards, aren't going to get paid if you're having issues. It's housing, it's food, right? Health, and it's prescriptions. Cars and credit cards, those usually get put off if things come up. So that's something to say that your assets are uh, a little more protected than everything else. Not saying that, when in times of crises, um, still can happen, but for the most part, those are assets that people will pay for, right? So if you're an income producing asset, it can benefit, right? Those are the hard tangible assets that really still have and can keep their value. Um, One of the things though within that real estate market is if you're super high leverage, like I talked about, if you were so high leveraged and you were counting on the interest rates to come down, now your risk increased, right? If you were saying, well, I got into this investment property or I got into this even home for myself or my family, and I'm losing money right now, or I'm barely getting by. But once the interest rates go down, I'll start being able to cash flow. And if you were banking on that, that could be an issue, right? That's now you're set yourself up for a potential pitfall if those rates don't come down. If the rates increase, right, and it again can cause issues. So that's one of the things to analyze is, are you over leveraged in certain aspects? How can you correct that? What are those factors surrounding it? Can you increase rents? Can you build an ADU? There's a ton of different things, ways, or to kind of slice at that. But if you are counting on those interest rates to come down so that you can start cash flowing, it's something to look at, right? It's you probably went into it a little too risky, a little too debt heavy, and now you're feeling the impacts of that. Um, if your asset is maybe short duration and you're just thinking about, look, I don't really care about interest rates. I'm looking in, I'm going to add value. I'm going to spruce up this property. I'm going to paint, whatever it is. Definitely account for the increased costs of goods, your material, your lumber, your paint, your labor. All those things are going to go up. But if you've still underwritten the property properly, and you're building enough margin in there, then you should be fine, right? And that's something to look at, is maybe tighten those margins, underwrite a little bit tighter, right? This is one of the things that we've been talking about with people is this is the time to be a little bit more conservative in those aspects of it, right? Um, One of the things we do see in this marketplace is a lot of the big banks, a lot of the big institutions, they will tighten all their lending, right? It's because a lot of it is tied to investors, their shareholders, sorry, and returning an investment, and they got to protect their shareholders. So they'll tighten their lending. Um, the liquidity contracts in the marketplace. There's less liquidity. They're not flooding the market with cheap, easy money. All right, we're seeing that. But at the end of the day, everybody still needs capital, right? We still need money to operate. We still our society is built on credit. It's built on credit lines, and it's built on liquidity and being able to. And when those factors are missing from the marketplace, those are times that we creates huge issues. So what does that do? Right, that creates opportunities, in my mind, in my vision. Right, the way I look at it is, this is opportunities where, as something we saw when at the beginning of COVID. Beginning of COVID, I remember the real estate market hit a standstill, right? People couldn't get finance. The banks were not lending. Uh, just just lending got super, super tight, right? And it was hard for people to get a mortgage. And it's loosened up since then some, but it was still super, super tight. One of the things, as ourselves, JSS Financial, as a private lender, uh, being small and nimble, we were able to pivot. We were able to shift our approach. We were able to shift where we were acquiring our capital to be able to fund deals. And then that's when we went really, really heavy into the private loan sector and being able to get capital from our investors, being able to fund these deals. We had some of the best years ever during the beginning of COVID. Why? Because we still had capital to lend. We were willing and able. We were able to pivot. We were able to change underwriting guidelines. We were able to underwrite files properly to still protect our investors, but more importantly, put liquidity and capital into our flippers' hands, into our people that needed it to be able to continue these markets to flow, right? And that's one of the things that we did. That's when my idea of JSS Capital really took off and really came to light, where it was like, look, we are out there searching for capital. So if we can give an alternative investment vehicle for people to be able to park some money with us at JSS Capital, and we can lend it out, and then being able to make a return on your investment with us, it increased, and it opened up the doors and opportunity for people to see that, right? We're very conservative in where we lend. We're usually 65-70% loan to value of the property. Short duration, we're lending in terms of 12-24 months. Get in, get out, get paid back. We're asset backed, right? We're our security is the collateral in the real estate. Anything goes wrong, we have the boots on the ground to be able to take the property back, foreclose if needed. But we have teams of agents, and we have teams of builders around the country who know how to step in and get these properties and either sell them. We can sell them to them, and they can finish the properties off and then put on the market. So we were able to create this pretty robust yield program where our investors can do very, very well with investing with us, right? It takes some of that risk away from you as a private investor, without having to go look for those opportunities in the real estate market, find the properties, and we can control that a little bit more, right? So it creates opportunities. Um, and what else do I have here? I mean, it's short-term debt is good in these types of crisis opportunities, right? Geopolitical crisis opportunities, because what happens is when you're the bond market, which is tied to the long-term 30-year notes and all the long-term debt, there's a lot of that uncertainty, right? As inflation hits, as that yield spread goes down, right? I think this morning we were below 4%, which we hadn't seen in a while. Um, when that yield spread goes down, we have to continue bumping interest rates up to attract more investors into that bond market, right? And that's how that capital markets works. So as we're giving them less yield, we have to increase interest rates to be able to provide more yield for possible investors. So that money's drying up in that aspect of it. Things are getting more expensive. Loans are getting more expensive, right? But we need to keep the capital flowing. We need to have real estate is a big driver of our economy, right? So um, how do we combat that? How do we protect ourselves, right? Like I talked about, right? One of the things that's super important is underwrite very conservatively, right? Avoid thin margins, like we talked about, right? It's being able to pad your margins in the sense that everything's going to be a little bit more expensive. How do you protect yourself against the downside? Um, Focus on projects that have a good cash flow right away, that that maybe aren't the sexy investments where, I'm going to buy this house on the beach and it's going to Airbnb for this amount, or vacation rentals, or whatever the case is, where you see, yeah, you know what, maybe those markets may shrink a little bit and get a little more contracted because, as fear and uncertainty hits, people aren't maybe vacationing as much or different things of that nature, right? So, but when you focus on maybe the less sexy products, where it's, I'm gonna buy a 2, 3, 4 unit, 5 unit, 6, whatever it is, and those are rentals, cheaper rentals that uh, you're gonna have butts in the seats, right? You're gonna have people living there all the time and people paying rent. It's a steady cash flow, and that's super important. If you're more of a passive investor where you're investing in these REITs, or you're investing in these big projects where you don't necessarily know where the money goes, right? Not a debt fund like us ourselves, but where you're an investor in a certain project, you want to also see where you sit in the capital stack. One of the things that I always teach potential investors when you're looking at these big projects, hotel projects, multifamily projects, it's where do you sit in the capital stack? Who's getting paid first, right? Usually, project goes sideways, your equity's gone, right? Your equity partners are out. They're going to ones who are going to get paid. Um, Debt is always going to get paid first, right? We have first lien position on properties. So where in that hierarchy is your payback? Is there going to be an ability for you to get paid back? If so, is it a percentage of your investment? Is it your whole investment? Things that always matter, right? So it's when things are great and you're making, 10x or whatever multiple you're making on your money is great. Um, but in times where a lot of uncertainty is, always know your downside. Always cover yourself, and you have to know where you fit in that capital stack. Where is your payback? Um, you know. But one of the things I want to talk about is, I'm gonna kind of end with this. It's not a time to panic. It's not a time to chase opportunities. It's a time to test your system. It's a time to operate on your system, to trust your systems. Um, to it's a time to again, just trust what you've built and how you've done it. Make modifications. Be open to change. Be open to pivot. But don't chase. Oh, I'm gonna go out and invest in oil because I think the price of oil is gonna go up. It can, um, but you're chasing this uncertainty that you don't. And if you're not familiar with that, be careful what you're playing with, right? Uh, it's stick to what you know. Stick to your proper underwriting. Tighten your risk margins. Increase your margins as much as possible. Look for cash flow opportunities. Look for some alternative investment vehicles that create a little more stability for your portfolio. Be disciplined, right? Discipline builds wealth. Take the emotion out of it. Uh, Emotion creates panic, and it allows for mistakes. Um, but like I said, discipline is what creates wealth. Those systems, those checks and balances that you need are the most important things to do. Um, have structure, have discipline, and don't be afraid. Stick to your guts, stick to your plan, and hopefully, if you've done things properly and you've protected your downside, you're going to be in a good spot, right? Look for opportunities, definitely, uh, but within those parameters. Don't throw your parameters out the window and go throw money at an opportunity. Still, play it smart. Um, Volatility doesn't eliminate opportunity. We know opportunity still exists. Pricing of it, the way it's priced may change. What it costs to get in, the cost of entry may have increased or may have decreased. Right? Look for those opportunities, all within your parameters and what your comfort and your safety zones are. Those are the things that I think are the most important. Be an operator. Um, you know, Guide yourself. Surround yourself with good information. Protect your portfolio. Don't allow for those overly exposed, thinking, hey, I'm going to sit on this for a little bit, waiting for the market to come back. Protect yourselves, get in, get out, make your profit. Don't get greedy. What do they say? Uh, Pigs get slaughtered. Everybody dies at the end. So I don't remember the saying, but don't be greedy, right? There's opportunities for everybody. Stick to your plan, stick to your focus. That's one of the things that us as JSS Financial at JSS Capital, we always do is we're helping guide people to protect your investments, asset backed, short durations, be very conservative with your leverage, get a good yield, right? Protect your cash flow, um, geopolitical events, test your portfolio. And these are great opportunities to be able to see where the holes in the wall are, and be able to plug them up and be able to protect yourself long term. So hope I brought a little bit of information out there. Again, love to talk to you. Love to be able to share our expertise. Love to be able to explain some alternative investment options, opportunities for you guys. But really help give some information out to the community so that we're all in a better place. And we're hoping for the best in all outcomes, and we're here. So follow us, and share our information, and we'd love to talk to you. Thank you very much.